Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 3rd, 2023. It's 10:25 a.m. Eastern Time. I'm starting the video, and what I'm going to do is start out with the very short-term or at least intermediate term outlook for the equity markets. We're just going to look at the 60-minute charts of the NASDAQ 100, ETF, futures, and the top components as I like to go through. And then we're going to loop out all the way to pretty much the longest term time frame I cover to look at the bigger trend, and that'll be the monthly charts. We'll look back, going back decades. And then really in the video, I'll cover three things. So we'll start out with the equity markets. I want to cover interest rates and commodities. And really where this all ties in is that negative feedback loop. I started talking about that last year, and I assumed and continue to believe it will be in play for the foreseeable future, and therefore it's a great way, if it continues to play out, to swing and trend trade to catch the bigger trends. All right, first off, again, 60-minute charts are best for looking out and trying to gauge where the markets are going to go in the coming days to weeks. And so, as I mentioned this morning in pre-market, we had a breakdown, and that's still very, very much intact. The fact they bought it up at the open, it just means you can now, you're on a sell signal, so you can short or add to any shorts at a higher price. My outlook has not changed one bit since last week. In fact, if anything, the higher prices go, the better those prices are if you are shorting or adding to any shorts. Now, with that being said, as I said this morning, we still have to fail the breakout. That'll be your next big sell signal. We had sell signal number one today on this nice clean up trend line on the 60-minute chart of QQQ. You can see it there. A lot of reactions on those candles. We gapped down below it as trades were indicating in pre-market, and they bought it up at the open, which again, I view that again, depending on where you're at, everyone's different. I've got a pretty hefty allotment of shorts right now, and whether I add to them or not, I'll probably wait until this breaks down, but I can tell you if I didn't have my fill, I'd be shorting right here pretty hard. There are, again, negative divergences. This is a big part. It's not everything, but it's a big part of my trading. I haven't seen, let me just be very clear, I have not seen as attractive a bearish setup for swing and trend short positions. I'm talking gains well into the double digits. I have not seen such a good setup all year. This is, we're already in April now, and this is by far one of the best setups since we've had so far this year. And again, the catalyst, well, number one, there's the breakdown one. Breakdown two comes on the drop back below that 313.60ish. That was key level. There was the post-Fed pop right there, breakout. And if it happens, this whole thing, as I suspect, will be because of the not just the technicals, but I'm going to go over a few things here. It won't be a super long video, but that would be a bear trap, a bull trap, false breakout, and then most likely have, I expect, a very swift, once this little this little rally is over, I think you're going to see massive exiting of longs, rushing to the exits, getting out of these positions, taking profits. Again, it's the technicals first and foremost. Fundamentals, I can talk all day long. I'll make a little bit of mention that in the video, but there it is. So that is 60-minute chart. That's of QQQ. Let me show you futures real quick. I got that out to you today. This is a 60-minute chart of the futures. Shows the same thing. You had a key level there. Let me make this tool different color here. It stands out a little better. Major reaction high there. Another one right there. Double top. And then we recently broke out. Now let me just check volume. I know on QQQ the volume's been dropping off, and a lot of stocks as well. And so this is it. So we have a sell signal. We have a breakdown right there. You can see a nice clean up trend line. Let me zoom in for you. You can see the divergences below. They're marked. We've been diverging, and unless they take those divergences out, that indicates a trend change is likely. There's a nice clean up trend line on NQ. You broke out. It was textbook so far, and that's why I can see I completely get the reasoning behind this buying. You took out, you're above the 200-day moving averages. You have a breakout, in a back test. But again, it's these divergences that tell me the probability is that the breakout will fail. And now that you're below trend line, well, that's the first step, and then next step will be again a drop below 13, give or take about 1374 on NQ, and then on the top holdings of the Nasdaq 100, all of them. Apple, big divergent high, nothing's changed. The only thing that's changed since last week is the divergence is a little bigger now than it was before, indicating once that turn comes, it's most likely going to be an even bigger drop than it would have been if the divergences started playing out right here when they started. There was your previous reaction high. So from that point on, right here, you started diverging, and you still have the uptrend line, which again, there's the comparable level to QQQ where that recent breakout was, 157.63. It is, to me, and let me be very clear, a 10 on a sell signal, because if you fall back below there on Apple, not only have you taken out all those previous highs, you can see boom, boom, boom at about 157. You broke out, successfully backed a little bit through there, but that's fine because you had two reaction lows right there, previous three actually, and so you basically back tested that whole level and rallied. So if we fall through there, you're going to have both a failure of a major breakout level that all eyes, a blind man can see that level right there, and then also the beautiful uptrend line, which again is just, if you keep it very simple, this is just one big bearish rising wedge pattern, right? And then the measured target I already gave you before. Well, I give it to you. It's you add the distance, the widest part of the wedge to where we break down. Again, that's going to be a moving target. It'll have to be moved once we break down, so I'll just leave it right about here for now. Let's just assume they break together. All right, so there's Apple. I'm going to rifle through them real quick. Microsoft, again, negative divergence. Divergent high, a little minor trend line in which to trigger a sell signal there. You have support right there. I'm going to give you the levels. And the way this works, if you want, set price alerts as and if each one gets taken out, that's going to increase the odds. And then you have a comparable uptrend line, which is kind of the nail in the coffin. I think, if Apple and Microsoft, they all break these uptrend lines right here that I'm highlighting off the early January lows, in my opinion, it's lights out for the market. Alphabet recently put in that divergent high with that spike high that was trade stuck. All the charting platforms have that, whatever wonky little candle. Somebody had a crazy order. That was a technical glitch on the exchange, but the trade must have stuck because the charting platforms never undid that spike candle there. So you also gave us that there it is, a little larger divergent high on Alphabet. Amazon divergent high. I know I sound like a broken record, and I'm sure a lot of you are thinking, "Oh, Randy, this rally, it's a runaway train." Again, this is what I trade off of. I look at the technicals, and the technicals are telling me that this rally is on the probably a very limited upside, and when it reverses, it's going to be a pretty powerful down. If all these divergences play out. Now, if they don't, again, I'll let you know. But as of now, nothing's changed. If anything, I like these short positions even better right now where they are. And again, once the recent breakouts fail, back down below those horizontal levels I gave you, that is the pretty much an all-in moment, in my opinion. Nvidia, negative divergence. I know I sound like a broken record, but this is what I do, and I start getting excited when I see all these divergent highs. Okay, and Tesla. Remember, Tesla, we already put in a divergent high here. We hit both of my first and second and final price target. Bounced as expected there, but even it just gave us another divergent high on the 60-minute chart. Meta, just a huge downside potential on this one once that trend line goes. You can see the common theme here. On this one, it was off the November lows, late November, early December right there. And a lot of the other key stocks and sectors and indexes was right there at the January highs. But that is a beautiful trend line, and to me, a beautiful bearish rising wedge pattern. So nothing's changed. I've been talking about this since a week or 2 weeks ago, and it's just gradually moving up. You can see the momentum indicator is dropping. That's the negative divergence showing you the momentum is waning. And one more. Let me jump over to the long-term charts now. That's what I want to show you. Okay, so that is all near-term stuff, right? Let's go to the S&P 500. The longest term that I typically will go to is a monthly time frame, meaning monthly candlestick charts. And let me turn off all the lines. One of I've talked about it many times, the best indicators out there in my opinion for both effectiveness combined with simplicity is the 20-month exponential moving average. That's the blue line. I put a 20-month, I'm sorry, it's yeah, it is the exponential. The yellow line is a simple. They both come in roughly together. The exponential is just going to react faster to prices. And let me show you. So you can see that it's just done, again, I've talked about it a million times in the past, a phenomenal job of defining bull and bear markets. This was one of the best, biggest bull markets in history up to that point in time, up to the dot-com bubble when it popped in March of 2000, and it just did a phenomenal job, meaning you'd stay long as the S&P remained above that level on a monthly basis. You would buy pullbacks to it, and even if you did that, you would have enhanced your returns by buying those pullbacks at that level. And then again, it's a great 401k indicator. When it breaks, you get out, and you would have sidestepped almost the entire vicious bear market from 2000 to late 2002, and then it told you to get back in 2003. You would have caught almost every bit of that bull market without any whipsaws. Told you to get out there. You would have sidestepped the bulk of the big bear market in 2007 to 2008, 55% or so drop. And then again, you can see all these little spikes through were typically intra-month closes. Intra-month breaks with closes right back on, and would have kept you long. And even if you got shaken out in COVID, you had one monthly close. In the very following month, the next month, you closed right back above the line, and it got you back in. Told you to stay into right here. So that's it. Fast forward, and here we are. There's our, we closed on it there. Boom, boom, boom. 4 months in a row, and then finally gave up the ghost right there. And again, you don't want to have to like zoom in super tight. We are above it. You want to see it clearly and solidly recovered, and again on a monthly basis. So what happens intra-month? Today is April 3rd. Completely insignificant. If we were up here going into April 26th, let's say, I'd say, look, you're almost certainly going to have a monthly close above it. But as of now, we'll look at this towards the end of the month. But you can see each and every month since we had the confirming sell signal, we were back testing it, came up to it, got rejected, rallied to it, couldn't get through it. Every single month on it, trading on or right above it. And there's that 20 simple, which I'm looking at too. It responds a little bit slower to prices, so you really want to see these guys cleared out. That's one trend indicator. The other trend indicator is the PPO histogram. When it is red, you are in a bear market. There's COVID, right? There's the fourth quarter 2018 drop. There's it was a bear market in most indexes and sectors back in 2015. Two big corrections, and at the very best it was a sideways market or a deer market for almost 2 years in the S&P 500, and it told you be out of that. There it is. So you can see the big drop 2007 to 2009, great bear, last true bear market, and then the big one back in 2007. So a near flawless indicator, about as good as it, well, two of them now combined. And then there's one more I haven't showed you lately that I've followed for years. Let me park the others real quick just to show you which one am I running here. I gotta go move pane. Let me do this. Let me flatten these down. I was running the beta version of this TC2000 recently, and one of them you have to drag. I'm not sure which. I was having a couple glitches. I think I went back to the other one. All right. So the ROC 12, rate of change 12. Again, a super simple and effective indicator, and I use these all together. Again, not any one of them. It's not a standalone, but you take them all together. And look at that. It just said throughout, we're rolling back here. Remember, we're going back decades, guys. This was bull market. Said long and strong. Keep your 401k in the market. Bear market right there. Caught almost all of the bear market back in 2000 to 2003. said long and strong, nothing but green bars throughout that bull market. Right around the top, it said get out, get short, or get out of your longs. And then it told you, I'm not zeroing in on the boxes, but there was your buy signal, and it coincided with the 20 month. Remember, this ROC12 has nothing to do with the 20 month. These are completely different indicators. I just showed you 3 indicators, and nothing's perfect. Now, there were some big corrections along the way that were really even tested the limits of a 20% drop. So there are a couple whipsaws, and you can play around. Sometimes I'll change it to an ROC 13. Again, there was that sideways to deer market. You would have been just as well to be out of your longs at that point, and it was red almost throughout that whole thing. Fourth quarter 2018 drop, COVID. So these were not whipsaws. They were not false sell signals. It just was super fast. The Fed has disallowed any bear markets. They put a pretty much an effective ban on bear markets in 2009. But this time around, they just couldn't. They couldn't prevent it. And you can see. Bottom line is, all my long-term indicators remain bearish. My longest-term indicators, and as such, again, I will continue to treat rallies, even if I trade them long. I will treat them as bear market rallies, and then I will look to position for the next, in swing positions, the next leg down. So until unless these start to change, it means we get a solid monthly close back above the 20 months. PPO histogram, we get a monthly again, a monthly green bar close. ROC 13. That to me is when things change. And based on my unwavering views since before this bear market even started, and throughout it since, I expected this to be a much different bear market than previous ones, and those that we're looking at here, going back for decades. I think it's going to be a much longer, slow playing one, and that's where I think that at this point, based on the duration of the previous bear markets, even going back to 2000 and 2007, I think that's where a lot of folks are confusing. These only lasted 1.4 years. This one lasted 2.4 years or 2.3 years. I think this one's going to be a lot longer. And so that's where I'm looking at it, that kind of roadmap. When you go to the shopping mall and it says you are here, and in this bear market, we're in the, like, in my opinion, we're probably in the third or fourth inning, maybe even, well, let's just say somewhere around there. And again, the takeaway, guys, is you will get crushed trying to trade the long-term charts in an active trading account, fast swing trading. This is longer term stuff, but then I align that with the short-term charts. So in other words, when I get the 60-minute divergences, which are typically my swing trading time frame, both bullish and bearish, that's when I look for the trend changes of swing. But when I get it on the daily chart, remember, very, very important, remember that on the more significant daily time frame, I gave you the clean, that was my busy board, this is a clean board. This is rare, and you get this in a bear market, again, that will typically project to a much larger move and longer term reversal, assuming these divergences play out, which I obviously believe they will. And by playing out, you need to have, again, you need to get the bearish crossover, and it needs to come below that previous high there. And so, it should come right around here. You can see on the daily chart, my uptrend line's a little more liberal than that on the 60. This is what the 60-minute chart looks like, the trend line. I'll leave it here. Either way, you've got a little bit more room to clearly take it out. And I use multiple time frames because I know some traders, this is what their go-to time frame is. Some are trading on the weekly charts, some are trading on 15-minute charts. But we say the shorter term charts will get you in and out of the positions quicker, but you also have a higher chance of taking a whipsaw trade, a false breakout. But again, we are on sell signals with the breakdowns today on the uptrend lines. And those divergences tell me I really think this one's going to be a fast rush for the exits when this turns. All right, a couple things I want to cover, and then we'll wrap this up. Rates. Okay, big part of my long-term outlook is fundamental analysis, but it's coupled with technical analysis. Fundamental analysis is kicking the tires, just looking at, economic indicators, looking at for companies, looking at their earnings, balance sheets, all that stuff. And then technical analysis, of course, is charting. Well, this is TYX, the 30-year Treasury bond yield. And this is a big part of my outlook here. Let me turn off all these lines. I have a bunch here. Let me make it very simple. This is, again, I've talked about this many times, and I don't think it's being talked about enough. This was a secular, that was a tail end. The data only goes back to the 70s, but we had rising interest rates in the last true inflationary environment almost 50 years ago. Back in the, we had a great bear market in the equity markets from the late 60s all the way through the mid 70s, and that's kind of what I'm looking at now. And so that was almost a decade of sideways and bear markets, and a rally, and you pretty much went hardly nowhere in the S&P 500. And then the economy and embarked on a secular bear trend, and it's so well defined. It just, you can't miss that trend line. You just have so many reactions, and that was taken out. So the Fed figured, for whatever reason, they figured, oh, we can keep lowering rates, and every time there's the markets go down, or the economy appears to be heading into recession, we'll just give it more liquidity, print more money, bring rates down. But then they realized, or I guess they weren't thinking ahead, that the floor is zero, and that they hit that again. We're looking at the 30-year bond here. They took their federal funds rate down to zero. Remember, the Fed does not directly set long-term bond or any bond rates. Those are set by market forces. Those are set at auction, and then they trade on the secondary market. The Fed sets the federal funds rate, and that is an overnight rate that banks can borrow from the Fed, and typically in an emergency use. And so you can see we've clearly taken out the trend at best case scenario, and we taken out many highs. At best case scenario, we come in my opinion, and that could give a boost to equities for a while, is come back in and back test that breakout. Although we did back test it right there, you back tested it right after the breakout. I just want to show you. So there's the 30-year, 10 years probably even more important. 30-year bonds, 30-year mortgages tend to track closer to the 10-year bond for whatever reason there. And you can see the breakout. You also took out all these previous reaction highs. So by every metric, this tells me that the secular bear market in interest rates is over. And I'm going to get to my negative feedback loop here in a second. All right, so you can see where everything's at. Even the 5-year, you can go to FVX, look at the 5-year, and you will see the same thing. And you don't really have to look hard or work hard to figure out where that trend line is. They were all taken out. And again, you can, and I already did this recently, I showed you, I'm not going to, this video will go forever, overlay the S&P 500 with this chart. And again, it's both technicals and fundamentals. It is immutable fact in the financial markets and investing that stocks do well in falling rate environments, and they do poorly in rising rate environments. Okay, and the last one is a DJP. That's the one of many commodity ETFs out there. And I've covered this chart many times. There were some comments on a site from a member recently, and we must be looking at different charts, because I pulled several commodity indexes. Commodities peaked, all the, or at least the majority. You might look at one that might not take total returns or something into account, or might be tracking futures that are rolling with decay, but commodities peaked back in 2008. And they have been, or were in, a clear, unmistakable, and one of the most powerful bear markets that they've been in. And it was an unusual one, because historically commodities tend to be positively correlated with the stock market, as one would think. When the economy is going up, the stock market goes up, and when the economy is growing. and there's a higher demand for commodities when things are chugging along. They're building more houses, they're building more commercial properties, they're building more airplanes, planes, trains, automobiles, you name it. So there's a higher demand for cement, steel, copper, iron. It's not, it's not rocket science. But something weird happened again. This is back in 2008. What was different? What would have made this happen? Well, I've said it all along. The Fed came in and completely destroyed the natural mechanism of what we call price discovery. That's a term in the financial markets that, that buyers and sellers will meeting together will determine prices and find, and the value of anything will be, it's not perfect, that mechanism, but it's an age-old process that values things for what they should be. But my theory is the massive distortions in the financial markets since 2008 most likely cause this. It doesn't matter if that's the reason or not. What does matter is these are commodities. The only things I can tell you with absolute certainty is the world is now, there's a lot more mouths to feed, a lot more people to have homes to be built for. There's less arable land, as forest and rainforest and temperate forests get cut down. There's less and less farmland. So it only stands to reason over time, commodities, for that reason alone, there's going to be a higher and higher demand as the world gets more populated. And so that alone is a great fundamental reason. But you don't need that. If you want to argue with me all day long, well, there's efficiencies now, and yeah, they're cut down the rainforest, but now they can grow in, and tons of soybeans down there. I know they're doing that in Brazil, and so they're just going to bring prices down. Again, we could sit there and debate the fundamentals all day long if you want to do that. What you cannot argue here is there's a very beautiful downtrend line. Again, I've covered this term many times. Downtrend line, downtrend. This was bear market, lower lows, lower highs, big bullish falling wedge, positive divergence. This is a weekly chart. And then boom, back here, shortly after the market's bottom, commodities broke out and they haven't looked back. And this is where I was, and some others, pounding the table and saying, Powell, what the F are you thinking? Commodity inflation's transitory. You can just look at it, and I've always said that this is the most accurate commodities because it's a real-time indicator. Housing market, the data is so lagged. There's things in the works. Interest rates go up, then there's this drop off, but there are already contracts, homes under contract, and there's some unique things going on too with the housing market right now that's keeping that part. I want to talk on that real quick. Sticky inflation, and that is because the average, I think the average mortgage rate out there right now is something like, I don't know, I heard like 3.5%, I think. I refied a couple of years ago, 2.49. I'll never, that's like free money, and it's tax deductible. So the net cost of capital is below 1.5%. It's crazy. And there's a lot of folks there like that. So now where I'm going is that's going to be a sticky component. They're saying those people will not sell. Typically you downside. I have one kid off in college now. The other's going to go off next year. And we have more house than we need. But guess what? What would be my benefit to downsize, to sell this house, to turn around and buy a house with a 7% mortgage? So I'm going to buy less house for the same amount of money. As far as the mortgage is insane. So that's the problem there, and that is one problem. It's well known. It's probably going to keep the housing market high, and so that component is going to be sticky inflation. And whether or not obviously it correlates to rental properties as well. So there's that. And again, we can argue that all day long. You can say, Randy, the housing market's going to crash. It's going to bring prices down. But you cannot argue that this is not a bull trend. And then we recently hit on DJP, we hit this target. So all along, got frothy here. There was a divergent high. Talked about that. I take some profits in commodities, but looking just like gold, look for a pullback, a correction. Nothing goes up forever. No bull market is straight up. And so you had that divergent high. You had a hell of a run off the lows. That was the end of the bear market, and what I still believe to be a beginning, the initial leg up, of a new bull market in commodities. This is what I see, and if over time the charts tell me otherwise, fine, so be it. But this to me looks like the beginning of a new bull market in commodities, and then When you look at this level here, $31 right there. I had some pullback targets along the way, 32, thought that might cap it, but I all along said this would be my max pullback target. And that was pretty much hit, that $31 level. And you can see you have a downtrend line we're at right now. Nice clean downtrend line. So DJP, and I'm seeing wheat, corn, soybean, those, everything else is starting to move up as well. We know what happened with crude oil. I'll get to that in 1 second. Big positive divergence. So again, these are the things that get me excited. Let me just show you crude oil. So positive divergence here, and at a trend line. So if we break out, we're probably going to, resume the next leg up in commodities, and that's going to be, I think, commodities equals inflation, rising commodity prices. USO. Way back in last year, gave you a final, same thing. You put in a divergent high, it was bearish, shorted crude, max pullback target, actually it was a sole swing target for a longer trade, 58.60, an uptrend line. Well, the uptrend line was hit first. That was right here. This was the same uptrend line. It's not been modified. And we bounced off the initial tag. There was a pretty good bounce off it. And at the time I mentioned, we fell a little shy, but we had positive divergence. Well, we went on, we took it out, and then we did hit that 58.60 level. It's just that this correction has been a little longer than I would have expected in time, but not so much in price. Came back pretty much exactly where it should have been. I haven't put up fibs, but let me just do that now and just see how much crude corrected off. That drop was right there, 38.2, even shy of the 50. So a typical counter trend rally, and we know what happened to crude today. It's up big, 5.7%. Look, took out the downtrend line. So all right, so this is all this is what I posted last year, that my ongoing theory or plan on how this bear market is likely to develop. It's going to be this negative feedback loop, and we're seeing it now. So it starts here. Let's just start at this point because it's a circular thing. Lower rates, and I said either expected or actual. Actual is an imperative word right now. If you've read the headlines recently, there's a tremendous disparity. It's a 180 between what Powell says the Fed's going to continue to do at this point in time and what the market is expecting. When you look at Fed funds futures, they're expecting a sharp drop off, a complete pivot from the Fed. Fundamentally, I can't even get my head around it, because if there's going to be a pivot, most likely there's going to be a major financial, another big problem. Just like first it was crypto blowing up, big crypto exchanges, crypto brokers, then of course the banks. I don't have to tell you about that. And that very well may not be over. Could be anything. Okay, could be a brokerage issue, insurance companies, pension funds have talked about, private equity. There's just a million things that can pop up. And to me, that's the only thing that's going to cause a sharp pullback in rates like that, especially with this whole thing. I don't think that the Fed's not going to have the ability. So right now you have expected lower rates, not actual. We have last meeting resulted in yet another cut. So it's 110% right now the market's expecting. That's the whole basis. The only reason I'm hearing this cited for this rally right now, and it's ridiculous because the odds of the recession continue to soar. Very, very, very reliable, historically reliable recession indicators. They're all firing. We're going into recession. And maybe that's why the Fed or the market is anticipating lower rates. But at the end of the day, it's just Pavlov's dogs. They're conditioned that lower rates equal higher stock prices, and that's not going to happen in a recession with earnings falling. So, anywho, we'll see. All right, so then stocks rally, but guess what? Usually not right away. For stocks will rally, but then ultimately commodities are going to rally, and that's what I just showed you. DJP itself is a very well balanced one. Energy, food, ag commodities, hard, soft, you name it, they're all in there, and we're starting to see that come. And so then with that comes rising commodity prices are inflationary, and that's going to cause stocks to go down. It's going to next cause this, you know, the Fed to stay tight, or the market to believe they're going to stay tight, maybe back off that whole. The Fed funds futures will start to probably back up on the longer end. Anyway, so this is what I posted last year. This is where we're at. So this is a stock market rally we've seen recently, and there's that one of the USO charts from last year. If I didn't show you that already, that one was back in September. It was that long-term swing target, which we just hit and reversed, and I mean, it's happening. This was today's ISM manufacturing report, came out at 10 a.m. Eastern. I don't know if you can see it here. The consensus was 47.5. The range was 46 to 49. It came in on the low end, below consensus. And this is a big one. It shows that manufacturing index dropping off. Anything below 50 is recessionary. This is to me, it's clear. I mean, we're heading that way. We're heading into a recessionary indicator. It can go down, but the trend is lower and will probably continue lower. And at some point, the market's going to realize that low rates, even if the Fed does pivot, it's only going to be because either there's another big crack in the financial system, some big problem, or the economy has clearly turned. You're going to see unemployment start to rise, and the Fed's going to back off that way. And again, valuations right now do not support equity prices are overvalued, especially. They're priced in at best optimistically that soft landing scenario, which I think is just, again, I think it's almost a virtual impossibility based on what everything is, what the forecasts are, all these indicators firing, recession indicators firing off some pretty solid sell signals now. So that's it. And just to summarize, from the long-term perspective, longest term, we're still in a bear market. Nothing has indicated that we've exited a bear market. Bear market rallies, to those that have never traded a bear market, they feel bullish. It feels like they're never going to stop going up. Feels like the bear market's over. But by every metric out there, a trend is simply defined as a bearish trend, an index or security making lower highs and lower lows, right? We start going up, and that's why I gave you back last year, or right around the end of the year, on QQQ, which is really where my focus is. I gave you, this is my busy board, the max. I give you two bounce target zones, a likely, where we were most likely to cap the rally, which we did a couple instances there. Oh no, that was the edge of the red box there. And now we're into the max potential bounce target zone, the lower end of it, and which is, again, this is where you start taking out this major reaction high, and then that starts to call the bear market into question. You're getting farther away from the 200s, and then more importantly, you at that point you're going to probably have taken back those all those indicators I gave you on the monthly. So at this point, this is a bear market rally that I really truly, same thing I said last week, is really, I believe, at the tail end of it. I thought we might have saw the end of it last week. We went up marginally, a little bit higher, and like I said, it's one of the better looking short ops that I've seen in a long time, and it'll get a whole lot better when we fail that recent. You can see it here, and that recent breakout pretty much aligned with that the delineation between my most likely bounce target zone right there and my maximum bounce target zone. So we popped into that. I think it'll be fleeting, and then yeah, that's it. Oh, and before I wrap up, same thing I've been saying for 2 or 3 weeks. If and when, which I believe it will, when the market rolls over and goes down, you're going to get more bang for your buck on the cryptos. Cryptos are ripe. Oh, I just added some Bitcoin shorts today, Bitcoin futures. This is a 60-minute chart. It's been a risk-on trade, as it has been. This Bitcoin crypto has been correlated with the stock market overall since the bear market began, highly correlated. And you can see there's a nice little uptrend line here, but most importantly, we've been just like the stock market, diverging, diverging, and diverging. And the naysayers might say, oh, well, divergence, and I'll say it too. It's not a sell signal. It's just an indication that a trend reversal is likely. Last time we had divergence was right here, negative divergence, that is. And of course, we had positive divergence at the lows. So as always, I'll leave it at this. I'll either be right or wrong. That's the only guarantee I'll ever give you is I'll be wrong a lot. I'm not wavering on my longer term call, short term, even short term. I think we're breakdown is imminent. There's a level right there that will probably do the trick. I have that trend line on BRR Bitcoin futures, that little uptrend line that should take us down to 26,726 or so, and then once that goes, but again, trade this along with the equity markets. Number one, know that they're correlated because they're risk on assets. Stocks going up, Bitcoin goes up. They both fall. You're going to get more bang for your buck shorting crypto, in my opinion. But you also want to see the sell signals on the equity markets, because if, let's just say hypothetically, Bitcoin takes out 26,726, but at the very same time the S&P 500 and or NASDAQ 100 come up to key support and they hold that support and start to rally, then that breakout is likely to fail in crypto. So keep that in mind, trade them together, and know too that you're not diversified if you are short QQQ and short Bitcoin at the same time. You have a concentrated, most likely correlated trade. There are some moments where people buying crypto and then we saw that recently when the banks started crapping out as a kind of a flight to safety bid. But all right, I'm going to leave it here. And same thing holds Ethereum. Same thing. It's almost identical divergences and same outlook. So I'm going to wrap the video up here, get it out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.